like I've been bullish energy. Now we have a little bit more potential disruption in energy supply, for example. Um, and so generally wars are historically commodity bullish in a bad way.
Yeah.
Um, both in, either in terms of increased demand for those commodities or in terms of disrupted supply for those commodities. It's generally war is generally bad for highly valued financial assets. So either bonds at low yields or stocks at high equity valuations, those tend to be punished in terms of war. It's yet to be seen how significant this war will be for the major powers. Right now, it's more localized, but I think one way to think about it is that inflation leads to disorganization, and disorganization leads to inflation. And another way of putting that is inflation can contribute to war, and war can contribute to inflation.
Lyn Alden delves deep into the Israel-Hamas war, complex relationship between inflation, global conflicts, and energy markets. Alden analyzes historical patterns, explaining how wars historically disrupt energy supplies and impact financial assets negatively. She emphasizes the interplay between inflation, disorganization, and war, hinting at the potential implications for the current Israel-Hamas war. Alden argues that the future might bring less order, more disruptions, and a need for increased resiliency, painting a thought-provoking picture of the structural changes ahead. She raises essential questions about the balance between inflation and economic growth, offering a critical perspective on the challenges faced by central banks. As Alden explores potential triggers for the next wave of inflation, including energy dynamics and government policies, you won't want to miss the thought-provoking insights she shares. Stay tuned to unravel the compelling conclusions and gain a deeper understanding of the intricate forces shaping our world.
So basically, when you get productive deflation, it basically means that things are organized, they're working well, we're increasing supply, and that's good for prices. It brings prices down on a lot of things. Whereas when you have disorganization, war, the need for duplication of everything you're trying to do for security purposes, um, that's all else being equal, inflationary. And I think that that's kind of the structural regime we're going into, one of less order, more disruptions, more duplication, more resiliency, which is generally an inflationary outlook. And I think energy is still going to be a key important thing this decade. Yeah, just generally during inflationary periods, statistically it tends to come in waves, right? So in the 70s, you had three major waves of inflation. In the 40s, you had three major waves of inflation. The 1910s were a little bit different because you just kind of had one big inflationary spike with the war, and then it kind of settled at a higher plateau. Um, Even in Weimar, if you look at like the price of gold in marks during that time, the central bank would fight back for time to time. They would like crush gold by like 80%, and before, they wouldn't be able to hold it down anymore and it would spike again, right? So you'd have this, instead of the smooth hyperinflationary trend, you had periods of fighting back.
Mm.
Um, and so it's not that we can't even, if you get a bad enough recession, you could even hit deflation for a period of time. The question is, when we try to have the next growth cycle, how do we get that without inflation coming back along with it? Or even if you don't have a growth cycle, you could run into outright stagflation. Um, and so I view it less as, okay, inflation's down, let's, kind of wave the flag of victory. Going forward, we still have structural deficits. We still have a lack of sufficient capex in the energy space, and the energy transport space. And so I think those things are going to be a recurring theme. Uh, you know, Maybe not 6 months from now. I don't know. That's more tradable. But I think certainly over a multi-year period. I mean, basically, they've already drawn down something like $1 trillion in reverse repos.
Mm.
They still have over a trillion left. Maybe a year, maybe 6 months. We'll see how quickly they pull that down. Once the Fed runs out of reverse repos, that's kind of like a liquidity battery, right? So they're reducing their balance sheet, which is tightening. But any money that comes out of reverse repos and gets pulled back into the financial system is pro liquidity. And so we've been in this ever since the March banking crisis. We've been in this kind of equilibrium phase
Mm.
of the Fed still trying to tighten, but also reverse repos are coming back on the market. Once the Fed no longer has reverse repos, it'd be very hard to maintain their balance sheet reduction, um, and their high rates, or at least both together, right? So I think the bigger constraint will be balance sheet size. You can technically hold rates of whatever you want as long as your balance sheet's flexible. But that's, if they get to a point where they're no longer able to reduce their balance sheet and they still have above target inflation, that can threaten central bank credibility. That can be pro liquidity at a time when inflation is still an issue. So I think that that could be a trigger for the second round of inflation. It could be energy driven. It could be the Fed no longer being able to tighten because of Treasury bond oversupply. There are a bunch of catalysts like that that can trigger the second wave of inflation, or at least a bottoming of inflation and then kind of remaining at above target inflation for a prolonged period of time.
Lyn delves into historical patterns, revealing the cyclical nature of inflation and its impact on commodities like gold, silver, particularly energy resources. She discusses the challenges posed by high public debt and large deficits, explaining how traditional methods of raising interest rates might not be as effective in curbing inflation in today's economic landscape. Lyn also sheds light on the concept of financial repression, where efforts are made to hold down interest rates while limiting private sector credit growth. She predicts a potential endgame involving these strategies, emphasizing the importance of closely monitoring central bank policies and their impact on commodities. Furthermore, Lyn analyzes the influence of a tight Federal Reserve and a strong dollar on commodities, highlighting the significant headwinds faced by these markets. She advises caution, suggesting that investors closely watch the Federal Reserve's balance sheet trends and anticipate shifts in energy prices. Investors seeking long-term strategies might find opportunities in energy producers, which often maintain profitability and dividends despite fluctuations in oil prices.
Financial repression, unfortunately. So and they use that in the 40s. A lot of developing countries use that today. Basically, what they do is here's the problem. If you're in like the 70s, right? So you have low public debt, um, and when you raise rates, it slows down bank lending. And although it does increase the deficits, the public sector deficits, it doesn't like the downward push on the private sector is much bigger. And so that's disinflationary. But when you have over 100% debt to GDP, when you have very large deficits, raising rates, although it does put downward pressure on the private sector, the upward pressure on inflation from larger fiscal deficits from higher interest expense is equal or sometimes even higher. And so one of the things that they try to do in a financial repression scenario is they try to have fairly low costs for the government while still trying to restrict the rate of private sector credit growth. Because, if you have 5% inflation, but you're doing yield curve control, and so yields are capped at 2%, for example, then every private sector entity has a big incentive to go out and borrow that currency, right? Because if you're going to get a negative real yield on your loan to buy something scarcer, you're incentivized to do that. So then what they try to do is they try to hold down interest rates while also restricting sources of credit growth, which is financial repression. And so I think that's kind of the end game that they're going to try. But I think they're going to exhaust a lot of steps before they get to that point. But we already see, the bank term funding program is already a very mild part of that because they're basically giving privileged rates in some ways to treasuries and mortgage-backed securities. Yeah, I mean, I think you see that also when you look at oil prices, when you look at energy producers. I mean, a lot of those are up significantly from their lows. We've seen a lot of action out of uranium lately. Some of that thesis has started to really play out. Um, Copper is more cyclical, so that's been a little bit more pressured, kind of during this tightening period. I think, generally speaking, when you have a very tight Fed and a very strong dollar, those are massive headwinds against commodities for at least for the period of time that they're able to sustain that, right? So it shouldn't be surprising that commodities have headwinds while they're able to do this. Whenever you see the balance sheet going down, um, that's it's not the only variable, but that's a big headwind against commodities. I think the way to look at this is what are commodities going to look like in, say, the 12 to 24 months once the Fed is no longer able to get their balance sheet down anymore, once they stop going down. That's generally the part I'd want to be very long commodities. And some commodities I'm already long. I've been sitting in uranium for 3 years. I've been sitting in energy producers. And the cool thing about energy producers is a lot of them are profitable and dividend paying at current oil prices. So oil can go down $10 or $20 a barrel, it can go up $10 or $20 a barrel. They are generally these profitable entities. You have a positive carry while you're waiting for what many of us expect to be a structural uptrend in energy prices after we get past this kind of, this period of pushback and tightening.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.